Hello, everyone. Glad to have you here. We'll give it 1 or 2 more minutes as we have people joining. So yeah, take a second to grab a cup of coffee, relax, and we'll be with you shortly. Can everyone confirm that they're seeing my screen?
Yes, we can see it. Yeah.
Yes.
Great.
Yes.
Excellent. All right, let's give it 30 more seconds and then we'll begin. All right. So, hi everyone. My name is Alexander. I'll be leading the innovation, fundraising, and investment readiness training. For your information, the recording is currently in session, so you will have the recording after the meeting as well as the presentation. If someone does mind, well, the process. So, yeah, also, I want to say that this is a webinar aimed at the 3 projects that F6S is running. So there will be various people here of various technologies, interests, maturity stages, and so forth. So yeah, have this in mind as we'll try to cover several things of interests of the projects. So let's begin. My name is Alexander. I have 9 years experience in European venture building, fundraising, and scaling tech startups. I managed 12 acceleration and innovation programs, some of which I have funded through proposal development. I'm an expert in exploitation strategies, sustainability plans, and scaling up innovation in diverse sectors. As you can imagine, in F6S, we're more tech-oriented, and the projects that we have been dealing with deal with the latest technologies, and the training will be suitable for this. However, the methodology of fundraising and innovation investment readiness can be applied to everyone despite the technology. So really quick, let's go around the room, just go into the chat and post on the scale from 1 to 5, how knowledgeable do we think we are of the fundraising process? This will help me tailor my language as well as the focus of this webinar. So if you don't mind, 1 to 5. All right, we have 2, we have 5. 3, 4, 2. All right, great. So diverse setup, great. So I will go into depth and I will also go into theory. So let's begin. On today's agenda, these are the things that we'll cover. So why fundraising, VC gain, the startup or innovation investment readiness level, the metrics, types of investor, how does the VC work, fundraising process, and partner tips and tricks. Have in mind, this is an over-encompassing training, and I'm not sure whether we'll make it in 45 minutes. Nevertheless, I do want to leave you with some slides that will be very beneficial to you, that you can take with you and look into them further if we do not make it. So, yeah. Why private fundraising for innovators? So in short, innovation fundraising is important, especially from the private perspective, to fuel rapid growth and market penetration, to help you build a killer team, product evolution at warp speed, marketing that actually works and that actually costs money, apart from the other one that is more well, that is not paid, basically. Staying in the game long enough to win, which in the high competition space is very important. So, however, it's tricky. But venture capital is the game that you have to be willing to play. This means that investors are looking for at least 3x in return in 7 to 10 years. It's a very risky space. It's a very risky game investing into early stage innovators who are even pre-revenue. And hence, with such a high risk, they expect a high return. But what does this mean? So a CVC, they're looking for 100x return in 7 to 10 years. If they're, the earlier, the greater the returns, right? Most companies fail, hence they need 1 or 2 or 3 per their portfolio that go beyond. But nevertheless, they're spreading the net and they're looking for all of them for this perspective. So a startup seeking high investment and high scalability and high growth needs to look at the, well, 1 billion euro exit in 7 to 10 years. This means that at 1 million euro investment, want a 10% at exit, have in mind, you'll need a 1 billion euro valuation at the exit to hit 100. This, in general, is very, very, well, high risk and high demand from the investors, which means that 100 million euro revenue in 7 to 10 years is something that you are looking to achieve in order to get these revenues. And obviously, these numbers really work well for the tech startups, for very scalable, low on infrastructure and so forth. However, each industry is different and there are specific aspects to it. Nevertheless, what does this tell us? We need a large market across the globe. So we have SAM, TAM, and SOM if people are not familiar with it, but this is something you need to look into. We're looking for capital efficiency, while some of the startups here or innovators here will look into technologies that is not necessarily software. Software is preferred due to the scalability of its focus and fast growth, right? So it's 2 times or 3 times year-on-year growth. Investors simply understand they invest in you and they're looking to sell you simply in the 3 to 7 years, and they need you to double or triple in revenue and growth each year. Looking into investment readiness levels, what does it mean to be ready? We have several things that investors look into, and especially looking at the various maturity stages and focus investors. But generally, it is the validation from the market, so customers, whether they are already paying or that you have interest in letters of intent and so forth, they're tackling the problem right. You have the market, so we've talked about the size and scope. Who are the competitors? How are you different? And what's your competitive advantage? We have the traction. So what have you done until now personally, as well as the company? What's the proof of your service and so forth? We have the structure, meaning investors are looking to understand the structure behind it all. It's not only the innovation that makes sense, but also the IP, the setup, legal setup behind the company, the people who also invested and so forth. Plan. This is something that perhaps is difficult for a startup to fully stick to, but while in some projects, especially in Horizon Europe and so forth, we have Gantt charts, work packages, tasks, deliverables, milestones. Startups tend to overlook this and stick to a very high level plan. It's important to have this. This validates your idea and enables people to understand what will you do next. The team, obviously, is the team right? The composition, whether simply people combine well. Finally, the business model behind it and the financial model that shows the operation in numbers. Look, I ran this through quickly, but there's also 3 other ways that we can assess the readiness. We have the tech readiness, we have the customer market readiness, and we have the investment readiness. In each, there are levels from 1 to 9. As you can know, in TRL levels, 1 to 3 or 4 is concept, 4 to 5, 6 is pilot demonstration and validation, and 7, 8, 9, or especially 8, 9 are commercialization. Same approach can be applied to customer market readiness and investment readiness with TRL levels. But in other words, they also cover these things in their own regard. But very important to understand where you are and to play the game and to play your development role. But several things what you should be asking yourself before even thinking, should I look towards a private investor when raising money? Are we as a business or a tech scalable, meaning we can replicate it quickly, easily across the globe, and sustainable, meaning can we sustain this growth? Can we sustain our methodology in another country? Can we replicate the technology easier and grow it further to continue providing value? How much capital do we need and what it will achieve? So the numbers behind investment rounds are very, very milestone oriented, and you'll see you look to raise specifically for what you're looking to achieve or develop. The timeline and strategy. So again, people start raising money up to a year and a half before they actually need it. Sometimes less, but it's between 6 months and 16 months. And you're looking to raise between 16 and 24 months ahead, or maybe 16 and 18 months for the future, so you have the money for this period. And finally, personally, I think this is a critical question that founders overlook. Are you ready for this increased accountability and pressure? Because suddenly you have expectations. You have people on your board of directors. You have equity given to someone else who simply makes you do these things, and they meet with you regularly and they overlook your growth. So it's the pressure that not only do you have towards your employees as well as other people, stakeholders, but also to the investors. This brings pressure. Nevertheless, I want to take a pause and to convey that the majority of founders never achieve product market fit. Indeed, this is quite shocking because simply startups focus on the technology and on innovation, and they forget about the problem. Meaning that the focus needs to be your customer and their need. So they are your North Star. You focus on them, you continually talk to them, and you iterate. Let's not forget, tech is beautiful to focus on. It's creating innovation Lego, but at the end of the day, if there's no one to buy it and then replicate this need, remember. Also, there's a need for an evidence-based, measurable progression towards a viable startup with a clear next steps and milestones. This is project management 101. And I understand in the ecosystem and mindset of a startup who, every day is throwing water on fire that is burning somewhere, and it's difficult to stick to a progress process. But data-driven plan, basically with the clear milestones, will help you grow as well as communicate to other stakeholders. And apologies for me really running through this presentation because I've really put too many slides as I would wanted to provide as much value to you. So investors love metrics. This being said, on the previous slide, I'm gonna give you a few to give you a taste for it. But at the end of the day, it's important for each founder to crunch this, and at every time of your fundraising process, know how to answer them. This is sort of demanding and pressure putting on you, but it's important to understand. So we have the unit economics. So this is the acquisition cost of a customer, the revenue per client, lifetime value, the recurring revenue, gross margins, and so forth, many of which are difficult to estimate at the pre-revenue stage. But due to your projections, talking to the customer and so forth, the investor like to see a projected numbers. Market data. So usually, especially in the proposals that I see when startups apply, or the pitch decks that when the startups send to investors, startups overlook some and some approach, but rather take the industry statistics over a global market, saying industry for agriculture product is going to raise by 5% to 700 billion euros. To an investor, this says, yes, there's a big market, but I would rather like you to focus on the markets that you are tackling. So the total number of industries, the service available is the one that you will be focusing on in the vicinity or in the future. And some is something that you think, based on your methodology of sales, that you can obtain. This gives us a better understanding of the market and what you can achieve. Customer loyalty and satisfaction through Net Promoter Score, yet it can be also calculated differently. Traction. So this is downloads, active users, retention, referrals, reviews, ratings, feedback. Again, also partnerships with other companies, whether you have entered the market, whether you have had incubators and accelerators in your portfolio, the programs, the advisors you have on board, and so forth. So what have you done until now other than shape up technology? Very important. Expenses allocation, so burn rate, runway, payroll, very important. While on the right side here, I want to show you some of the statistics or the KPIs, not the KPIs, the metrics that the investors use. So this is on their end. Valuation, multiple on investment capital, and internal rate of return, something that they are looking on their end. While this is something on the innovator's end. Type of investors. So I assume majority of people here are probably pre-seed and seed. This is here. I also put the TRL levels, as well as the checks or the funding round, sort of that investors fund. So here, early stage innovators focus on grants, accelerators, crowdfunding, angels in some developed regions, or friends, family, and pools. Once you're in a growing, scaling expansion stage, so this is the commercial level and so forth. This is venture capital series ABC, the EIC, mergers and acquisition, private equity, and so forth. Then the chunks become bigger. The numbers, the metrics that the investors look in become slightly different. And worth saying here is something that the innovators forget, is the fact that, sure, yes, the checks can be all of these ranges, but the rounds, meaning if you're raising 1 million within the seed phase, 1 million might come from 5 different investors. So You might find an anchor investor. So this is an investor who leads the round, does the due diligence, does the contracting, does the nitty-gritty work that is very demanding. Beatrice, I've seen your hand. 1 second. And once they give the approval, the other investors are more happy to jump on board, and getting them on board is much easier. So if in case an innovator fails to run, well, has trouble raising a full round of 1 million from one investor, which is normal, then multiple investors might jump in. Beatrice, sure, let's bring up the question. Now you're muted.
Hi, yeah, so sorry to interrupt. It's just that I feel my question is really on this slide. So basically, if I am in the seed days right now, I already received a couple of investments. I'm about to receive a grant, but I'm discussing with several funds that are telling me it's too expensive for us to perform a due diligence on you. You invest only just like 1 million or 1.5 million. So we are waiting for a leader and then we just follow, you know. But in this case, I was thinking, okay, maybe it's worth to find someone that can perform a due diligence for like on myself, maybe hopefully for a reduced amount of money, and maybe upload it in the data room. But I don't know if this is the right strategy. Like, what would you do in my situation?
To be honest, I've not heard of a situation where an external consultant slash auditor of sorts is brought in to do a due diligence for an investor. Mostly because in the due diligence, apart from your feasibility, financial, both technical and so forth, they also look to see their fit within their thesis and strategy. This means that, yeah, they're looking to see if you are aligned with what they want. You know, this means that I would continue searching for investors if I was you.
Okay.
Not everyone wants to be the lead or the anchor investor or the lead investor, and this is fine. But it's good that at least you do have a soft interest from them saying, look, I have soft interest. Now you can take this soft interest and communicate it to someone else and say, look, we have soft interest from these investors. That means that someone else is more keen to listen to you and jump into the due diligence for them. So continue looking for investors and leverage this soft interest for brokering the conversation.
Okay,
Does this answer?
thank you. Yeah, thank you very much.
Good. Okay, moving on. To give everyone who's not familiar with the life cycle of VC, just an overview, how does the VC work? So they fundraise from their own investors. They create the fund. For the next 2 to 4 years, they invest their money. Then they have probably 4 to 6 years of time for passive investments into their portfolio to give them a boost, a bridge, or a follow-on investment. And at the end, they try to sell you. This means that in this period, you're looking for investment from an investor. So in case they're somewhere here, they won't be investing into you, despite the fact that the fund is up and running. Meaning, you're always looking to understand when the fund has been established. This is clearly this can be seen easily on the internet, on Crunchbase, Dealroom, and similar platforms. So, and you're looking to understand whether they have the leftover money. Obviously, there's a bit on when the investors are more keen to spend it in the beginning or at the end. But at the end of the day, this is something that you're looking forward to. Now, how does VC source deal flow? And try to think of this from your perspective, right? So we can see that the early stages, they're generated through their professional network, self-generated, referred by other investors. They're coming from company management, whether it's pitch decks submitted on, or simply deal scripting online, whether it has been referred by company or quantitative sourcing. This can already tell you majority of these come from a verified source and it's recommended. The rest, or coming from a cold email or a pitch deck uploaded to the website, it tends to be overlooked and is not taken so seriously. So, meaning introduction from verified sources, this is the probability for success. Event attendance, yes, they do want to shake your hand and see that you both had the money and ability to come to a verified event and to talk to them. Yeah. So moving on. A typical fundraising process can last between 4 to 12 weeks, and this is after there was time for them to meet you and agreed that they would jump into it. So they might meet you and so forth, but as Beatrice is saying, we're not really willing to jump into it. But in case they do jump into it, they consider you seriously, they're looking forward to it, this is the process. So initial meeting, partners call in internally, right? In the beginning, the pitch deck is covered and called with the analysts. And then the partners meeting internally for them, they analyze this a little more. Then the evaluation starts taking place. This is the due diligence of financial, technology, market, sales, and so forth. This can take forever. No, I don't want to say forever, but a long time, because the due diligence is really going into details. Like they call your clients to check on you. They call other investors to check on you. They look into each technical document that you have. They have in-depth discussions with everyone, and this is the expensive part. As Beatrice is saying, we don't have the money to dedicate for the due diligence to cover you. We're looking for someone else to say this was done, and then we'll just follow them and believe them that this is true. But if they're doing it, it just takes time. And then there's an investment committee, again, meeting in front of the whole team, the discussion. And only then the term sheet negotiation starts. This is the legal aspect, the lawyers jump in, commercial and legal terms and so forth. All right, I see that here I put the due diligence while I was talking about it here. I jumped into it, but all right, my mistake here. So the evaluation initially is with the team, product team, and so forth. The due diligence tends to be longer and built on the initial understanding of the analysts. Now, shareholders agreement and the legal execution of the term sheet by the highly specialized law firm, both on their end and on your end. Cannot stress enough how important it is to have a good lawyer, and we'll get to it why. But it's not uncommon for an investor to know the founder and the company for at least a year before they invest, which is like a chicken or an egg story, like how long are you going to know me before you invest, and when can we start, and so forth, and how hot am I for you to start talking to me, and so forth. So it requires patience. This is what I'm aiming at. Now, on the topic of deal room, I've crafted it in this way, and I realized, a lot of us think business plans, but a business plan is a full story, which can be broken down into pitch deck and can be broken down into a teaser. So similar aspects are covered, and I'll show it to you on the next slide. And then we have the financial model, which are the usual financial statements from profit, loss, balance sheet, and so forth. The admin docs, these are the legal admin stuff. Nevertheless, this is everything that needs to be prepared, regulated, meaning updated regularly, and always set on time. Fundraising is not when you need it, but you're planning for it and you're always ready for it. So I mentioned the business plan, pitch deck, and I'm sorry, my nose is itchy. This is the way I thought to make it easy for everyone when I'm advising startups. So you can take the full business plan aspect, but depends on what time, right? When the due diligence comes, you're showing the investors everything. But in the first introduction or something a little more low key, then you're showing a teaser or a pitch deck, right? So think of it like this. Things to remember. I'm keen to say that no one reads lengthy business plans anymore. Sexy presentations are preferred, especially because a casual investor does get 1,000 of them a year, or at least to get to invest into 10. So imagine having to read 60 pages of 1,000 business plans, right? So don't overload with information on pitch decks. More information will be requested. So for example, detailed technical overview. This can be several pages of text, sure, but in the pitch deck, cover it in one slide. And don't kill people with a technical overview unless you're asked. Link to VC investment thesis. So once researching investor, understand what is it that they're aiming for, because they also have their own investors that they are satisfying, and everyone has their own agenda. Don't bother looking to chase investors who simply have an investment thesis or an agenda that is not your company. You will be wasting your time and their time. Also, pitch deck upload to the website. I've tried it. It's poor conversion. Really, referrals will get you further, whether it's from an advisor, from an incubator, an accelerator, you've been there, or simply from someone that knows the VC themselves. Try to get it. But even I need to reflect back to this referral. Referral is simply not like, hey, Alec, introduce me to the investor. I see them on LinkedIn. Alec needs to know why is it that you are a good fit, so I can recommend you. Because if I don't bulletproof that you are a good fit for them, my credibility is lost by recommending you to them. So there's this tricky thing. Now, searching for investors. So they are your soulmate, right? A soulmate because they will stick with you between 4 to 10 years, right? You're looking for a polygamous relationship because there are many investors, but you're looking for those with extensive industry knowledge that can help you in the future, with track record in your industry. Again, something that can be seen on Deal Room and Crunchbase. A wide network of the industry among investors and so forth, because you will, if you start playing the game, most probably look to raise again. If you don't raise again, then you're not really playing the game. This is unfortunate to tell, because every investor wants to sell you to the next round investor, and they want you to grow. Unless you're very, very techy, where revenue pays for your growth, you will be probably funding your expansion through fundraising. Nevertheless, strong reputation, that's needless to say. Now, Deal Room, Crunchbase, LinkedIn, Google, even AdSuccess, these are good platforms to start by. Deal Room, Crunchbase can be expensive, but as a founder, what I realized on Deal Room, you can get 6 months of free account. I think you need to find the request for this, but I managed to get it to start up some fundraising war. Now, financial muscle, right? Ability to follow on, much easier to fundraise from an investor that knows you than from a new one, right? A balance ticket. So here it's tricky. Don't pump your valuation too high and look for too much money, because this will well, condemn you for a fast-paced, high-intensive, very demanding future years or upcoming years, and the KPIs that you need to satisfy, right? Third, partnership, cultural fit, and long-term marriage. I think I've covered this. But don't after the conversation and meeting someone, don't stray away from your gut feeling. It will tell you a lot. But now, a few thoughts on the pitch deck. So, what founders often usually think that the pitch deck usually is about. So whether it's a presentation style, a memorized pitch, impressive numbers and projections, polished slide deck, charismatic delivery. And what I really, really hate is trendy buzzwords because they don't really say anything like, sustainability. But what actually matters is the following. So what's beneath the surface, right? Understanding of the market and those numbers. Scalable business model that relies on the scalable tech. Clear competitive advantage. Now, a joke, to toss in a joke, I think some of you have seen the comparison between Rolex and the frog watch. When the frog watch tells the time, is a frog and is cheap, and Rolex is none of them. I mean, is a frog watch better? I don't know. Realistic financial projections, I think whatever you're posting on there will be surveyed by financial experts. So they'll be looking into your Excel sheet with a magnifying glass. IP protection, I think, not everything can be IP protected. However, every IP strategy can be analyzed. If you're saying we will protect it in the future and not say something, it's clear that you have not thought about it, or you haven't taken the time, or you're simply ChatGPTing this. Don't. So long-term vision. I think on the term of vision down to the KPIs, I think it's very important to understand the mission, vision, or vision, mission, then product or strategy, product, teams, KPIs and milestones in that kind of way go. And the culture, the processes, and the management manage all of this. Very important to understand. Now, unique value proposition. Yeah, we need to understand how are you providing value. It can be simply, we're next level AI, machine learning, whatever, tossing buzzwords that do not say how are you solving the problem. Don't go around tossing buzzwords, which we hate. Tell me simply how are you solving the problem. Like, you will get to the tech part, sure, but at the end of the day, if, for example, we are Uber, we're enabling an easy, user-friendly way for a person to get on-demand transportation. Let's not go into too much detail explaining it, right? The rest, as you can see, I think it's clear. Don't need to go into each, but I'm trying to paint a picture. Pitch deck is just a sales document at the end of the day, which relies on very in-depth reasoning and strategy. Now, Alec, give us some 10 tips on how to own this game, right? So I said introductions are the key. Not going to go into this. Something worth considering is create a buzz or fear of missing out. There are several ways you can do it, whether through recommendations, through branding, through press releases, through news, through influencers, through simply mentioning to investors that you have someone who's willing to jump on board already, like we had with Beatrice. Don't fail on communications and PowerPoint visuals. I think in the age where we live in, sloppy visuals or outdated visuals like Microsoft 2000 year, PowerPoint 2000 from 2000 year, right? Or communication that are simply broken language or so forth. Like everyone can check this in ChatGPT or use proper visual. But also, I think the visuals of the PowerPoint are important because at the end of the day, they'll help you convey or sell something. Investment, both if you are graphically advanced or in terms of the money you might pay someone, matter, right? Now, don't be defensive. Yes, we're not here to suck up to the investors. Sorry, pardon my French, but we also need to take into account what they're saying, but also hold our ground at the end of the day. I'm going to put the caveat here, or be a devil's advocate here. Not more often than not, in the beginning, you'll be talking to an analyst and so forth. Sure, they may have their own thesis and they have their own reasoning. For example, why B2C is not working and you should be B2B. But address their concerns rationally. And also on the point 8, this is free consulting. Probably they've seen more pitch decks and more solutions than you, especially if you're getting a proper answer from them. Why not take it into account? Now, tier 3, tier 2, and tier 1 investors. In my mind, this is a strategy. So tier 1 are the investors you want. Tier 2 are someone that, you could have, but they're not as awesome as tier 1. And tier 3 are those that simply, you don't necessarily want. Nevertheless, you want to test your approach to an investor in tier 3. So you can polish out your strategy on how to talk to an investor in tier 2 and tier 1. So this is important. It takes time. It takes time to reach them. It takes time to pitch and everything. Nevertheless, plan this. So when the tier 1 opportunity comes, you nail it down with awesomeness, right? You know your stuff. You checked it. You received feedback before. You're coming in prepared. Now, include investors in your mailing list and send them regular updates. This keeps them on the loop, updates and them on your product design or whatever you've been doing. And at the end of the day, they keep you in their mind, right? There's a saying in Serbian, away from the heart, away from eyes, away from the heart, or something like this, right? So keep them in the loop. Raise for 18 to 24 months. A longer time, no one wants to give you this much money, but also don't want to risk it, because at the end of the day, this is how much you need to get to the market, unless you're super deep tech. And be milestone and outcome based. I want to know, if I'm giving you 500,000, that you will get to 1,000 clients, that you will enter the market, that you will solve your IP issue, that you will develop the team, establish. Apologies, that was coming up for 30 minutes. All right. Take back. Take feedback. I mentioned it. So free consulting. Also, dumb money slows you down. You want experts on your team. You don't want someone that is a loan shark, that is simply someone with money and that will be pressuring you without knowing your industry. Stick to them. And finally, if you can't answer the metric mentioned in the economics part, you're toast. This is the methodology of reasoning and numbers that the investors operate in, and they care about the money. I mean, more than sure, they care about you and the technology, but at the end of the day, they care about the 10 to 20% equity they will be having, and they want to sell you. Because at the end of the day, and here's a bit of an insight, when investor looks into you, they're also developing scenarios for your growth development. So in their due diligence, there are like scenario 1, 2, 3, 4. In the case of the most positive one, we'll be selling them in 3 years to this investor. They already know them at this valuation, and this needs to happen. And they have the hypothesis, they have the reasoning, and they have the scenario, right? And they have the 4 scenarios. Let's say 2 positive, 2 negative. What will they do with you? Because yeah, it's a buy and sell at the end of the day economy. But taking this recommendation ahead, think about having a slide on your pitch deck that elaborates on these scenarios for them. I think it will be very appreciated by the investor because you've done the work for them. Let's say you're a sensor for agri-tech, and you're thinking, all right, scenario a merger and acquisition by John Deere. They will be buying us out. How we have an advisor who is in contact with them, and so forth. And you list the 3 or 4 scenarios for their exit. It's worth maybe, again, being a devil's advocate to myself. Pre-revenue startups tend to do not do this because, come on, let's be real, you have other things to worry than to think, all right, in 5 years, what will I do? Let me make it to year 2. Nevertheless, you're in this business and this is the game that you should be playing. All right, here are the few slides I'm gonna drop you now with. Not gonna go too much into detail, but this is, bonus for you. I have an email example for you that you can use. To be honest, I've used ChatGPT for this with the proper prompts, but this is something you can tailor, very short, very to the point, very metrics-based, outcome-oriented, understandable when you reach out to an investor. Here's the term sheet structure. I would really recommend you look this with your lawyer when the time comes. But a lot of things that are not self-explanatory for someone who has not looked into this. Also, sort of to the term sheet aspect, elaboration on each of these things that I would really ask you to look into once the time comes. But want more details on this? I've hyperlinked the venture capital term sheet, which came out recently from HSBC, and a beautiful document which will cover all of these things for you to give you a greater update. So happily, I managed to do it in 45 minutes, while at the same time I could have done this in 3 hours. So I really hope that I wasn't too fast, because I was. Let's open up for questions. So feel free to turn on your video. Let's go with hands raised and go one by one so we don't interrupt each other. But I would really love a conversation to take place now. Does anyone want to share their situation right now, where they're at? Maybe a learning or something, or even to contradict me, because I may have said something. Well, in that case, Nicola.
Hello, Alexander.
Hi.
Thank you very much, first of all, for the great presentation, packed with value. So I really loved it. One thing I wanted to ask you, in your perspective, sometimes young startups tend to run on like collaborators more than actual employees. Maybe they're key collaborators with proper, of course, agreements. But do you think that is a major point for an investor, or something like puts them gives them a little bit of warning because they are not sure whether these collaborators should be or are fully engaged to the startups.
Yeah, let me toss back a question to you. So in the future, should someone give you X amount of money, will these collaborators become full-time?
Probably yes.
I think this answers your question because we all know startup is a hustle world until you get profitable or until you fundraise, right? So currently, we understand all of you do other things. We gotta make a living, right? But should we give you 500,000 or 1 million? I want you to give me assurance that you will drop other things and commit to this full time. But if you don't, then it's a risk management for me. Like I'm giving someone money who doesn't want to commit their full time to this. Then the question is, who is full time here and who is not? Who is critical for the development? Does the company need subcontracting and will work just fine if it doesn't? So obviously, in the due diligence and in the conversation, this can be explained. But the founders and the critical management needs to be full time. I think this is undisputable.
I agree with that. And how would you show, for example, back to the question you asked me, like if I were to give you a total X amount of money, would you make this collaborator full time? If the collaborator is not, let's say, full time yet, how would I show the investor that those people are committed to go full time once we have enough money?
I think that it comes down to trust. But also have in mind the investor will be on a monthly or quarterly call with you and they will be looking into this and they might even come to your office to see you. But when it comes to proving this, yeah, it's a good question. I really don't know. But, oh, wait, contract. I mean, you provide contract with all of your employees and in the contract it states full-time or whatever. If it doesn't say full-time, well, you might say, it should say full-time.
Yeah, of course. I was curious about whether there were like specific expectations of something provided to investors to prove that. But I also agree with you that most likely, since it's a relationship that established between the investor and the company, most likely if someone goes away from the company, they will notice afterwards.
Yeah. Good. Any
Okay,
other questions, Nicola?
That was. I will have many probably if I think about it a little harder, but probably too many for the. I don't want to steal any other participant's time.
Well, let's give other people an opportunity to speak up, and if not, we'll come back to you. Anyone else? Feel free. No? All right. Well, Nicola, if you came up with another question, now is the time.
Okay, then one just right off the bat. I was interested when you looked and you showed us the slide basically regarding how to search for an investor, right? And um, so you basically showed us that most companies that also get invested in are actually selected through personal networks of investors. So the, let's say, outbound uh, search they do is actually very limited compared to the, let's say, amount of companies they evaluate through personal networks. Is there, in your experience, this is totally subjective, any, what are the best, let's say, ways to engage them, to know them? Is it like personally through events, like participate at these events and just show up there and go talk to them, or I don't know, any kind of tip for that part?
So, for example, I'm gonna zoom in here. All right, you see my LinkedIn, right? All right, I'm bringing up South Central Ventures. They're the dominant VC in the Balkan region. I know them because perhaps I Googled dominant VCs in the region, right? Apart from going onto their website and seeing their thesis, I might go to people. You have associate members, and then here you see the connection. I think it's fair to say, ask any of these 81 connections that I currently have, please connect me with Milos or any of the other people. I know Milos personally, so I could go send without a note. You could add a note. It is a stretch, I must say, I've tried it. Add a note, look, I am, you're down to 200 characters. You take this email, and basically you crunch this into 200 characters. Or, which is nothing, but you can put it in the ChatGPT and be like, look, give me really, I don't want to say thought-provoking, but eye-grabbing a way to convey these things, and send them an invitation. This might not work, but yeah. Unfortunately, the development of LinkedIn and the social networks now dictate, or at least the unspoken narrative here is, be engaging on the website, on LinkedIn, post things, comment, and then when the time comes for you to connect with Milos, he would have seen you commenting, he would have seen you something, and he will be keen more to accept. So there's this aspect to it. I personally do not post on LinkedIn too much, but I see networking is done in digital way like this very, very proficiently. So there's that. Event attendance is the key, especially since in the events, investors do come with an agenda, and you have the app that helps you network with critical mind and targeted way. So you simply send in a message like this, want to meet up, and set up a 15 minutes meeting. So events do make sense, especially for investors. Recommendations, accelerators, incubators. Look, I'm fundraising with 2 startups right now. We've tried all of these things. I'm not saying that the pitch decks do not work by being uploaded to the website, but it's really in the low digits success rate.
Yeah, thanks. Thank you for this perspective. It's also, I ask this also because we try sometimes to work on LinkedIn, but these days, people are getting targeted with hundreds and hundreds of messages on LinkedIn. I have the feeling that just messaging people doesn't really work anymore. So probably we need to go back to the human relationship to make things work.
That's true. Cool. I see people are slowly exiting, and I feel it's we're coming to an end. So I want to thank everyone and thank Nicola for your questions. I hope you enjoyed this, and we'll be sending you the presentation.
Thank you very much.